Welcome to the deep dive. Today we are focusing our analytical lens on a company that, well, it really supplies the fundamental infrastructure of the American home.
It really does.
We're talking about everything from the paint on your walls to the faucet you use every single morning. Masco Corporation, ticker MAS.
Right.
And we are synthesizing a pretty extensive, high-level investment report to answer one core question. Is this industrial giant, known for powerhouse brands like Delta Faucet and Behr paint, a compelling investment right now, especially with all the recent market jitters?
And that's the critical mission, isn't it? Because if you just look at the recent headlines, they show weakness. The market is definitely nervous.
For sure.
But when we talk about Masco, we're discussing a company whose fundamental identity today is that of a leading high-margin manufacturer with, and this is crucial, a wide and durable economic moat.
A moat.
The central investment thesis we have to validate is this. Has Masco fundamentally transformed itself? Has it strategically refocused almost entirely on the stable repair and remodel market, the R&R market?
And is that pivot enough to insulate them from the extreme, often painful cyclicality of new construction?
Exactly. That's the billion-dollar question.
Okay, let's unpack that transformation.
Yeah.
Because the market is noisy. Q3 2025 net sales were down 3% year-on-year, and management trimmed their full-year earnings per share, their EPS guidance, slightly.
Just a trim, but the market reacts.
Of course. So we have to filter out that noise and focus on the long-term value creation. So what makes R&R such a foundational driver?
Well, it's the aging U.S. housing stock.
Yeah.
I mean, think about it. Homes get older, things break, people want to update their kitchens and bathrooms. It's a constant source of demand.
And that demand is fueling this R&R segment, which is projected to hit a massive, $509 billion in the U.S. by 2025?
A huge, stable market. That's the kind of thing you can really anchor an investment thesis around.
So to understand where they are today, we really have to go back.
To understand the quality of the assets Masco owns today, you absolutely have to appreciate the torturous journey it took to get here. It was a history of wild swings.
It wasn't a straight line.
Not at all. Masco's origins trace all the way back to 1929, starting as the Masco Screw Products Company. Just machining auto parts in Detroit, a standard, low-margin industrial supplier.
And here's where it gets really interesting, because the first pivotal moment that defined their future identity happened right in the middle of the century. The founder, Alex Manoogian, he wasn't satisfied with just auto parts.
No, he was an inventor.
He invented the successful single-handle Delta faucet in 1954.
And this was pure genius. It wasn't just a product innovation.
It was a marketing innovation.
It was a marketing innovation. He used pioneering national television advertising to sell a consumer product that, previously required two hands and often leaked.
That's a huge deal.
It instantly shifted the company's identity from a generic supplier to a branded, consumer-focused plumbing fixture leader. And that established the two core DNA strands of Masco: product innovation and brand marketing in plumbing.
But that success, it sort of set the stage for the next phase, which was really the opposite of focus, wasn't it? The era of expansion and complexity.
The polar opposite. Richard Manoogian took the reins in 1967, and for decades he drove aggressive and, I would say, often unwieldy expansion.
Unwieldy is a good word for it.
And when we say unwieldy, we mean it. The acquisition spree was just relentless. I mean, consider this. Between 1997 and 2002 alone, Masco acquired over 40 companies.
40 companies?
Spending approximately $10 billion. And they weren't just buying related plumbing or paint businesses. They diversified wildly into cabinets, windows, installation services.
Anything related to home construction.
Pretty much. They ballooned into this sprawling Fortune 500 conglomerate, reaching a peak of around $11.8 billion in sales by 2007. So yes, that created scale, but what was the downside?
The complexity must have been a nightmare.
The critical analysis is this. While that sheer size created diversity, it introduced immense operational complexity. But more importantly for the investment profile, it dramatically increased Masco's vulnerability to cyclical new construction markets.
Right. Cabinets, windows, installation services, they're all highly dependent on new homes being built.
Exactly. Masco became completely tethered to the housing cycle, which, as we all know, can be absolutely brutal.
And the housing cycle was brutal. The Great Recession wake-up call starting in 2007 made that vulnerability violently, painfully clear.
Indeed. CEO Timothy Wadhams had to navigate the housing collapse. They'd built this near $12 billion sales behemoth, and then suddenly sales just plunged.
How far did they fall?
Down to roughly $7.6 billion by 2010. They just had too many complex, low-margin businesses that completely vanished when construction stopped.
That drop vividly underscored the inherent danger of relying so heavily on new construction. It really proved that diversity without a strategic focus creates risk, not resilience.
A hard lesson to learn. The company survived through aggressive, necessary cost-cutting, but its share price and returns languished for years. And that really set the stage for the definitive strategic pivot.
And that pivot belongs to the Allman refocus era, starting in 2014. Keith Allman led a decisive pivot to transition Masco from a supplier of, well, general construction materials to a much leaner R&R-focused entity. What exactly did he chop off?
These were not minor trims, this was major surgery. And it was all aimed at improving the return on invested capital, the ROIC of the entire portfolio.
So what went first?
First, in 2015, they spun off installation services, which now operates as the successful company TopBuild. Second, and this was most critical to their margins, they completely divested the lower-margin, highly cyclical cabinetry and window units by 2020.
Let's put that divestiture into context. They sold businesses that contributed about, what, $1.7 billion in 2018 sales? That's a significant chunk of revenue to just let go of.
It is, but here's the key takeaway for long-term investors. Those $1.7 billion in sales only generated about 10% of the company's operating profit.
Wow. Okay, that's the key stat.
It is. They essentially got rid of nearly 1/6 of their revenue, but retained 9/10 of your operating profit engine.
So why does this matter for the long-term investment case? It means they shed the complexity and cyclicality without meaningfully hurting the core profitability.
Exactly. This transformation completed Masco's shift away from volatility. They shed the low-return, high-cyclicality baggage, leaving a core centered entirely on high-margin branded products, plumbing with Delta and Hansgrohe, and decorative architectural products with Behr and Kills.
So the historical trajectory shows a management team that's ultimately willing to make tough, corrective choices.
Even if it's later than ideal, yes. It indicates a long-term resilience and adaptability that we have to factor heavily into the investment thesis. They learned the hardest way possible, but they learned.
That dramatic history leads us naturally to the management that executed that pivot. The legacy of strategic execution under former CEO Keith Allman is, well, it's undeniable. He delivered strong results post-refocus.
The numbers are very clear on that.
He achieved a double-digit compound annual growth rate in EPS, the EPS AGR, and approximately 14% annual total shareholder return, or TSR, over his tenure.
And before we move on, let's just clarify those terms for everyone. When we talk about TSR, total shareholder return, we're talking about how much shareholders actually made, combining both the stock price appreciation and the dividends.
The total return.
Yes. And a 14% annual TSR is a very, very strong return over a decade. And EPS AGR just means they grew their profit per share at a double-digit rate, which is excellent.
That performance suggests a deeply ingrained culture of operational execution. Tell me about the corporate headcount reduction. It went from a staggering 32,500 employees in 2007 down to roughly 18,000 by 2024. How did they manage that without cannibalizing their core operational talent?
Well, that reduction is a testament to the focus on efficiency. A lot of that reduction came from shedding those non-core, personnel-heavy businesses like installation services and the complex manufacturing for windows and cabinets.
So it wasn't just layoffs.
No, it was strategic divestiture. They kept the talent focused on brand, on R&D, and on global supply chain management for Delta and Behr, where the margins are highest. They learned from that unwieldy conglomerate era that simply being big doesn't make you profitable.
Now we come to the current leadership transition, which is a critical juncture and, frankly, the source of some of that market nervousness we mentioned.
A big question mark for investors.
John Nudi was appointed as the new CEO in July 2025, succeeding Allman.
And what's fascinating here is that Nudi is an industry outsider. He arrives with 30 years of high-level experience from General Mills, a massive consumer goods giant.
So that introduces some uncertainty.
It does, but that uncertainty is strongly offset by his background. He brings crucial consumer brand expertise, which is vital for premium products like Behr paint and Delta faucets. And he was already familiar with Masco, having served on the board.
So that mitigates the risk a bit. He's not a complete unknown.
Exactly. It's not like they pulled a random name out of a hat. He knows the business from a strategic level.
You also have a new CFO, Rick Westenberg, appointed in October 2023. So you have two fresh faces in the top seats. But if Nudi is an outsider, who is providing the necessary day-to-day operational stability?
That stability comes from below, which is a really good sign of bench strength. The operational continuity is provided by seasoned divisional presidents who continue to run the core money-making brands, Delta and Behr,
The people who know the nuts and bolts.
the people who run the factories and the sales channels. Nudi's job is strategic vision and capital allocation, leveraging his consumer insights.
Okay, let's run through the Masco management scorecard based on the research. If we look at the last decade's performance, how do they rate on key strategic metrics?
Overall, the rating is strong, but with some nuance. Starting with strategic vision, we'd rate them as strong. They delivered substantial value via that bold portfolio refocus. They correctly anticipated the long-term stability of the R&R market, and they acted decisively.
But didn't the critique point out that the spin-offs came after the housing crisis? Was Ullman cleaning up his own house, or was the pivot truly visionary?
That's a sharp challenge, and is why the vision, while strong, isn't perfect. He certainly inherited, and you could argue contributed to, the overextension pre-2007.
Right.
However, the vision was to move past merely surviving the crisis to structurally avoiding the next one. The decision to sell off the cabinetry and windows segment in 2020, years after the recession ended, shows a long-term commitment to shedding low-quality revenue streams, even when the market was stable. That persistence elevates the rating.
What about financial management?
Also rated strong. They maintain a prudent balance sheet with moderate leverage, around 2 times net debt to EBITDA, which provides enormous safety. And critically, they have been aggressive with value-accretive share repurchases. Now, this leads to a key accounting point that can confuse people.
Okay.
The company's accounting results show negative book equity.
We absolutely need to define that clearly, because for a financially literate but busy listener, negative equity sounds like bankruptcy.
It sounds terrifying, but it's not. Negative book equity here is not a sign of losses or financial distress. It is a technical accounting result.
So what does it mean?
It means that the value of the shares the company has bought back and retired, and they've retired roughly 20% of their shares just between 2018 and 2023, has exceeded the original capital contributed and the retained earnings on the books.
Ah, okay, so they're just returning capital so efficiently that they've used up the accounting bucket for it.
Precisely. It is a sign of high cash flow and efficient capital return, not a solvency risk. A very important distinction.
Incredibly important. Finally, adaptability. How did they score on handling external shocks?
We rate that moderate to high. Why only moderate to high? Well, they demonstrated high adaptability through those major strategic business exits and their swift reaction to tariff challenges. For instance, in response to escalating trade tensions, they cut their China sourcing footprint by about 45% since 2018.
That's a massive operational feat.
It's huge. However, they still got caught by the latest tariff increase, which is currently costing them dearly. This suggests strong resilience and a quick response time, but not perfect foresight to completely avoid the hit, hence the moderate to high rating.
And if we look at shareholder alignment, the final inference, it seems exceptionally strong, cemented by those performance metrics.
It is the bedrock of the investment case. Management incentives are heavily tied to long-term shareholder value, specifically multi-year return on invested capital ROIC and TSR targets relative to their peers.
So they only get paid if they deploy capital effectively and if the stock performs better than their competitors.
That's it. It aligns them perfectly.
Mm-hmm.
And the company is highly shareholder-friendly, evidenced by their commitment to consistent dividends, which they've nearly tripled over the last decade, and of course those aggressive buybacks.
This alignment provides a powerful backstop to the stock's valuation, doesn't it?
It absolutely does.
We've established Masco's disciplined history of refocusing and the strong alignment of its leadership, proving they are no longer the sprawling, risky conglomerate of 2007. So now let's see what that focus looks like on the ground.
The actual businesses.
The specific businesses and brands that form its competitive foundation and how that structure generates reliable cash flows.
And Masco deliberately streamlined into 2 synergistic high-margin segments, plumbing and decorative architectural products. This structure provides a crucial balance that enhances resilience.
Why is that balance so important?
Because the decorative segment is highly reliant on DIY consumer trends, people making trips to Home Depot, while the plumbing segment is more tied to professional installation, remodeling backlogs, and wholesale supply houses.
So they aren't relying on one single fickle customer base.
Exactly. We need to explore how these 2 engines, working together, generate durable competitive advantage and cash flow, which at the end of the day is the definition of a wide moat.
And that deliberate pruning they did was the key.
It was, replacing highly cyclical, low-margin revenues with these two core pillars. That was the necessary foundation for this segment balance. The quality of these assets is what gives them their pricing power.
Okay, let's start with the segment composition and demand profile. Factually, plumbing products, that's Delta, Hansgrohe, Hot Spring Spas, they represent the majority, about two-thirds of total revenue.
Right, and that caters primarily to replacement and remodel demand.
Then the decorative architectural segment, Behr, Kills, Liberty Hardware, accounts for the remainder, and that's overwhelmingly tied to R&R and the DIY consumer.
This focused portfolio benefits enormously from the sheer size and stability of that R&R market, which, to reiterate, accounts for an estimated 85% of Masco's total revenue.
And the current balance provides fantastic resilience. You can see it in the recent cycles.
Oh, absolutely. Think about how this played out. When lockdowns hit in 2020, strong DIY paint growth helped offset the slower professional plumbing installation work.
And now it's the reverse.
Now it's the reverse. Amid recent softness, professional plumbing demand has held up much better than DIY paint, which saw its sales down 12% in Q3 2025. This dual segment structure helps smooth out demand volatility dramatically.
So if the business model is resilient, let's look at the sources of the competitive advantage. What's fascinating here is how Masco's wide economic moat is constructed. It's a combination of brand and scale that makes it, well, nearly impossible for new players to enter.
The foundation is undeniably brand strength. We're talking about Delta Faucet's lifetime warranties, which give a professional plumber total peace of mind, and Behr's perceived quality among retail consumers. It often ranks highly in customer satisfaction surveys.
And that loyalty is sticky, isn't it? Once a pro trusts Delta or a DIYer successfully uses Behr, they tend to stick with it.
Very sticky. And that allows Masco to maintain premium pricing power.
The second factor is scale and cost efficiency. Masco operates a global manufacturing footprint that gives it significant procurement leverage for raw materials, be it brass, zinc, or the specialty resins for paint.
And they can spread their R&D and marketing spending over a huge $7 to $8 billion annual revenue base. A smaller competitor just can't match that.
That scale is essential because it feeds directly into the third major component, channel relationships and concentration risk.
Yes, Masco uses a balanced multi-channel approach, 46% retail and 54% wholesale trade.
Let's talk about the elephant in the room, the Home Depot factor. Masco's deep partnership with HD is both a massive competitive barrier, it's what makes Behr so successful, but it's also Masco's single largest customer.
It is. Historically, it's accounted for an estimated 30% to 35% of total revenue due to the exclusive Behr arrangement.
Doesn't that risk Home Depot squeezing their margins?
It is a profound concentration risk, and you can be sure Masco is deeply aware of it. They mitigate this risk by becoming truly indispensable to Home Depot.
How do they do that?
By ensuring they maintain perfect in-stock levels, co-developing products that HD can exclusively market, and providing superior logistics. Behr's exclusivity is a major bargaining chip for Masco. If HD were to switch, they would face massive consumer backlash and logistic chaos.
So Masco uses Behr's market share dominance in DIY retail as leverage against HD to maintain favorable margin agreements.
Precisely. And critically, they aggressively cultivate the professional and wholesale channel through plumbing supply houses and independent dealers to ensure they have independent revenue streams outside of big box retail.
That 54% wholesale figure is the firewall.
It's the firewall against the HD concentration risk. If Home Depot tried to push too hard, Masco could lean harder into the non-retail segment.
Finally, let's look at market share and growth runway. Behr has an estimated 20% of the U.S. architectural paint market. That's a powerful figure, especially compared to competitors like Sherwin-Williams or PPG, who focus more on the professional market.
That 20% show makes Behr the dominant force in the DIY retail segment. In plumbing, their combined faucet brands command 15% to 20% of the U.S. market.
And looking ahead, where does the growth come from?
Well, the overall plumbing market is projected to grow faster at around an 8% CAGR through 2030, driven by replacement demand and urbanization. Architectural coatings are projected to grow more moderately at around 3.5% CAGR.
So Masco's ability to outpace these stable rates really hinges on innovation.
Continuous innovation. Things like smart plumbing features, new finishes, and leveraging their international presence, particularly with the Hansgrohe brand. The growth may be moderate, but it's highly predictable because they serve that core R&R need.
Masco's brand strength and channel leverage translate directly into pricing power and favorable unit economics. That wide moat we just detailed is the structural advantage that protects their profitability.
It is. However, we have to confront the fact that recent margins have been severely challenged by external shocks.
We absolutely do. The real question is, how does Delta's brand loyalty in a wholesale house actually translate into pricing power in Q4 when inflation and external tariffs are hitting raw material costs?
Right. The theory has to meet reality.
We need to look closely at the engine room. What happens when volume slows down, especially when facing massive cost pressures? We are seeing the tension between their strong underlying efficiency, which generates high free cash flow, and the near-term pain points.
The inflation in those elevated import duties. It's a temporary headwind impacting a structurally sound business. Let's drill into the unit economics and see the impact of that high operating leverage.
Let's do it. Let's analyze the margin structure. Masco's business model is inherently highly cash generative.
It's a cash machine.
The decorative segment, the paint, offers high gross margins, typically in the mid-40s range. This leverages the low variable cost of the paint product relative to the premium price consumers pay for a trusted brand like Behr.
Right, and plumbing margins are slightly lower, in the 30% to 40% range, due to higher raw material costs like brass and electronic components.
The key concept for an investor to grasp here is operating leverage, isn't it?
It's everything. Masco has a substantial fixed cost base. The factories, the R&D centers, the massive marketing spend to maintain Delta and Behr's status. When demand surges, as it did in 2020 and 2021, those fixed costs are spread widely over high volume.
And the high contribution margins mean a large portion of every incremental sale falls straight to the bottom line,
Leading to incredible margin expansion. It's a beautiful thing on the way up.
But the reverse effect is the problem we're seeing now. If volume slows, even slightly, that fixed cost base weighs down the profitability disproportionately.
Precisely. When volume declines, as seen recently with the DIY paint softness, that fixed cost base causes disproportionate margin contraction or deleveraging. We saw plumbing segment margins fall from approximately 20% a year ago down to about 16% in Q3 2025.
That 4 percentage point drop is a massive hit.
It's a huge hit, and it's exacerbated by external factors they can't control.
And the most significant uncontrollable external factor is the tariff pain point. Masco is facing substantial near-term headwinds from elevated import duties, primarily hitting its globally sourced plumbing segment.
The cost is alarming, and we need to contextualize it for the listener. Management estimates the tariff impact will be approximately $150 million for the full year 2025.
And that's an increase from earlier projections.
It is. If we assume Masco's projected 2025 EPS is around $4 per share, that $150 million cost is roughly 60 to 70 cents per share.
Wow.
This shows how crucial tariff mitigation is to the near-term investment thesis. It's an enormous non-operational tax on their business that hits margins directly.
So how is management responding to a $150 million cost that they cannot simply wish away?
Their primary mitigation strategies are immediate price increases, which they've done multiple times, and the acceleration of supplier diversification away from China.
We noted they cut China sourcing by 45% since 2018.
And they are prioritizing moving the supply chain to lower cost, tariff-free regions like Mexico, Vietnam, and other Southeast Asian nations. But the margin hit is immediate, while the supply chain shifts take time, often years, to fully realize their cost savings.
That explains why their margin dip is so sharp right now. They are absorbing the cost while the mitigation is still underway.
Exactly. It's a timing mismatch.
Let's also touch on inventory management and agility. Inventory turns are around 4.5 times annually, which is generally healthy, but the sudden drop-off in DIY demand led to an inventory build, particularly in decorative paints.
Right, and that required them to take inventory-related reserves in Q3 2025.
So what does that signal?
This was a brief, albeit costly, execution lapse in accurately forecasting the speed of the DIY slowdown. It happens when consumer behavior changes faster than the supply chain can react.
So it's not a long-term problem?
I don't think so. Management quickly addressed it by cutting production and adjusting orders. They expect inventory levels to normalize by mid-2026. This isn't a structural issue or a sign of product obsolescence. It's a cyclical timing mismatch that cost them some temporary reserves.
So the ultimate inference on scalability outlook, then, seems fundamentally positive provided conditions stabilize.
It is. The underlying efficiency of the cost structure remains completely intact. The near-term margin dip is cyclical, not structural. If volume recovers, which we expect as R&R activity eventually normalizes due to the aging housing stock.
And if tariff pressure eases.
Or if Masco realizes the offsets from its diversification, they have significant operating leverage. That means they can drive margins back into the high teens with relatively small volume increases, facilitating a powerful rebound in EPS.
And the low CapEx helps.
Immensely. The fact that they target a high free cash flow conversion of roughly 90% of net income, with low required capital expenditure, around 2% of sales, confirms that this is an asset-light cash flow machine that is currently just temporarily weighed down by external costs.
We've established that the core business is highly efficient, though it faces temporary, significant margin pressure from those tariffs and the soft DIY demand. We know Masco is resilient, but the ultimate question for the investor is always,
Does the financial picture support the story?
exactly, does the balance sheet, the valuation, and the accounting, does it all support this long-term thesis?
And what stands out here is that Masco's history of high cash conversion and its moderate debt profile provide a substantial margin of safety. They're not struggling for liquidity.
So now we assess the valuation.
Before we commit serious capital, we need to assess the valuation relative to its quality, and then check under the hood for any financial red flags, ensuring the earnings quality is robust. The operational pain points are temporary, but the financial structure needs to be permanent.
Let's look at Section 5, focusing on the numbers that matter.
Starting with profitability and returns. We know adjusted operating margins compressed to the mid-teens, around 16% in 2025, guidance, down from that 18% to 19% high we saw in the renovation frenzy of 2021 and 2022.
And that compression is purely volume and tariff related.
Completely. But the more structural metric, the true measure of management's value creation, is return on invested capital, or ROIC.
And how does that look?
It has been robust, consistently in the 15% to 20% range. To give that context, that comfortably exceeds their estimated cost of capital, which is around 8%.
So they're creating real value.
Consistently high ROIC validates the value creation that resulted from those post-divestiture portfolio choices. It tells you the quality of the assets they kept is high, and they are generating more return than the capital cost them.
And the cash flow.
Coupled with that, free cash flow generation remains strong, over $700 million expected in 2024, yielding an attractive free cash flow yield of about 6% to 7%.
That strong cash flow generation supports the stability of the balance sheet. Tell us about the leverage.
It's moderate and safe. Net debt is approximately $3.0 billion, which equates to a moderate net debt EBITDA of roughly 2.0x. This is well within their comfort zone and far from distressed.
And liquidity is strong.
Ample. They have $1.56 billion in cash, plus an undrawn credit revolver. They maintain an investment-grade debt rating from credit agencies and high interest coverage over 10 times EBIT to administrate to Chikup to Sefter. Interest minimizes financial distress risk.
And we must reiterate, the negative shareholder equity is purely an accounting artifact of those aggressive, value-accretive buybacks. It is a sign of financial efficiency, not weakness.
We can't stress that enough. It's a good thing, not a bad thing in this case.
Turning to the valuation assessment. At the current price, around $65 per share in late 2025, Masco trades at approximately 16.3 times 2025 estimated adjusted earnings. What does that multiple tell us about the market sentiment?
It tells us the stock is currently pricing in the bad news.
The tariffs, the volume softness.
The CEO transition risk. All of it. This multiple is modestly below Masco's historical averages and substantially below many high-growth peers in the building product space, which can trade up to 25 times earnings. The market is cautioning itself, reflecting the pain of that $150 million tariff hit.
But what happens when that pain point eases?
Well, if earnings rebound to, say, $4.50 per share, which is entirely plausible with margin normalization and a moderate R&R recovery, the forward price-to-earnings multiple would instantly drop to around 14 times.
That suggests the stock is currently moderately undervalued to fairly valued.
With significant upside potential tied to the cyclical recovery and the success of those cost mitigation triggers, you are paying a fair price for a high-quality asset that is currently experiencing temporary pain.
Now, for the forensic accounting review, we trust the management, but can we trust the books? Are there any hidden liabilities or red flags we should worry about?
Masco's earnings quality appears high, which is essential for a stable investment. Operating cash flow consistently exceeds net income.
Which is always a very strong sign.
Always. It means the actual cash coming in the door is higher than the profits they are reporting, indicating non-manipulated high-quality earnings. They use non-GAAP adjustments, but they clearly reconcile them, generally just to normalize for one-time events rather than to inflate performance.
And no restatements or SEC inquiries of note.
None noted in recent history. The largest watch item is external, the transparent communication of that massive $150 million tariff cost, and managing the working capital swings related to inventory. Governance is solid, with a successful transition away from founding family dominance and robust insider stock ownership guidelines. We see no major accounting red flags.
So we can trust the financial structure supporting the operational story.
I believe so.
Masco has made its financials transparent and its structure efficient. Let's dedicate time to what they do with the massive amount of cash they generate. This is the story of the buyback and dividend machine, an integral part of the investment thesis.
It really is. Masco prioritizes shareholders above almost all else in its capital allocation structure, which is a significant change from the empire-building era of the 1990s.
The numbers are staggering.
They returned $3.3 billion via buybacks from 2018 through 2023, effectively retiring roughly 20% of the shares outstanding. At the same time, the dividend has been a point of pride, grown at approximately 7% CAGR over the last 5 years, having nearly tripled over a decade.
That focus provides a high shareholder yield. The dividend plus buyback yield has been in the attractive 5% to 7% range in recent years. This is what truly provides that powerful valuation floor we keep mentioning.
It is. If the stock drops too far, Masco's own buyback program becomes the dominant, aggressive buyer, protecting long-term investors.
The other key feature of their allocation is M&A discipline, and here they show they really learned from the conglomerate era.
Yes, Masco's primary M&A focus has been on divestitures, top build, cabinets, windows, rather than empire building. The $1 billion in proceeds from the 2019 divestitures were effectively used for buybacks and debt paydown,
Proving that asset sales were a smarter financial move than keeping the assets.
They are not interested in adding complex cyclical businesses just to boost revenue anymore.
And the case study that really illustrates their renewed discipline is the Kichler Lighting acquisition.
Yes, they acquired Kichler Lighting for $550 million in 2018. When it quickly underperformed their expectations and internal return hurdles, they sold it just 1 year later in 2019.
That is fast.
That demonstrated management's swift willingness to cut losses and avoid unrelated acquisitions, which is a crucial sign of financial discipline that was sorely lacking decades ago. They will only buy if the bolt-on acquisition meets strict, high-return criteria.
And this feeds directly back into incentive alignment. Why are management so focused on disciplined capital?
Because their compensation is structured around it. Executive long-term incentive plans, or LTIPs, are performance-based, vesting specifically on multi-year ROIC and TSR targets relative to their peers.
So they're incentivized to pursue only profitable growth and highly efficient capital use.
Aligning perfectly with shareholder goals. And the new CEO, John Nudi, received a significant equity grant, locking him into the long-term success of the company right from the start.
Looking ahead, what are the likely future capital moves?
Because the core business only requires modest capital expenditure, around 2% of sales annually, a huge portion of operating cash flow is deemed excess. Masco is highly likely to maintain or even accelerate buybacks if the stock remains at these modest multiples.
And any M&A will be small.
Small, strategic bolt-ons, perhaps in niche plumbing technology or geographic expansion, but they will be held to those strict return hurdles. Masco is effectively positioned to be a highly selective, consistent returner of capital, making it an excellent holding for investors prioritizing cash returns and share count reduction.
So what does this all mean? Let's bring together the major insights from our historical, operational, and financial deep dive into Masco Corporation. We've gone past the noise of the last quarter.
I think we have. And we see a company that went through painful but successful self-correction. It transformed away from the overextension of the conglomerate era and emerged as a focused, resilient R&R leader.
And the current issues are cyclical.
The current earnings issues are cyclical, namely tariffs and volume dips, but they are manageable, and the underlying moat remains wide and intact.
Okay, let's synthesize the 5 key takeaways that define the investment case.
First, moat durability. Masco's competitive moat is robust. It's built on scale, decades-long brand loyalty with Delta and Behr, and deep channel partnerships, notably that exclusive Behr arrangement with Home Depot, which provides strong pricing power.
Second, R&R resilience. The deliberate strategic shift to the repair and remodel segment, which accounts for about 85% of their exposure, provides a much steadier growth platform. And this is supported by the powerful secular tailwind of the aging U.S. housing stock.
Third, financial quality. The company generates high-quality earnings, evidenced by operating cash flow consistently exceeding net income. It operates with moderate, safe leverage 2 times EBITDA and maintains superior returns on invested capital, consistently exceeding 15%.
Fourth, temporary headwinds. This is the current drag. Near-term earnings are constrained by external factors, specifically the estimated $150 million in tariff costs for 2025, which translates to a significant EPS hit and that cyclical slowdown in DIY paint demand.
And finally, fifth, valuation and return. The stock appears moderately undervalued, trading around 16 times forward EPS, and offers a compelling shareholder yield from dividends and buybacks, a 5% to 7% shareholder yield, which establishes a strong valuation backstop.
So what's the ultimate investment verdict? Is this a buy today?
Masco is a solid long-term holding. I would say a neutral to cautiously optimistic stance is prudent right now. The quality justifies the price, but investors should monitor key catalysts to trigger the re-rating we discussed.
Okay, so what are those key triggers to watch?
The most important positive trigger is a clear pickup in R&R activity. We would see that signaled by improving order volumes and backlogs in the professional plumbing segment.
And the second?
Tangible success in tariff mitigation. Masco needs to prove it can restore that 100 to 150 basis points of margin by 2026 through supply chain shifts and pricing actions.
And on the downside?
Investors must watch for 2 risks. A sustained multi-year housing recession that causes remodeling spend to turn sharply negative, or a disruption in that critical Home Depot relationship, which would instantly erode brand leverage.
That brings us to our closing thoughts on the complexity of assessing a high-quality business mid-cycle. The core strength is clearly there, the transformation is complete, and the balance sheet is pristine. The investment thesis relies on the cyclical pain easing.
Patience is required while they navigate these external tariff and volume headwinds.
Yep.
We've discussed Masco's historical willingness to innovate, pointing to products like smart plumbing features and new paint formulas. Given the new CEO, John Nudi's extensive consumer brand background from General Mills, the final provocative thought for you to consider is this. Masco has strong brands, but smart home technology integration is messy.
Very messy.
How quickly will Nudi leverage his consumer brand expertise to successfully integrate smart home technology across his plumbing portfolio? Think sophisticated, voice-activated, or touchless faucets. And could that technological shift in premiumization be the next major growth vector that finally re-rates the stock into a premium multiple? That's what Smart Capital will be looking for next.